Hi all, welcome everyone to week 8 of BUSS1030. So in this week we talk about income statements. So we're getting introduced to the three main financial statements: the income statement, the balance sheets, and the cash flow statement. And then we're going to do that in that order. So starting this week off with the income statement, let's just get right into the content. Alright, so the income statement, by the end of this video, we should be able to explain the purpose of an income statement, which is quite straightforward. Also known as the profit and loss statement by some textbooks, the importance of measuring financial performance, the stakeholders that need to look at or perhaps have a vested interest in looking at the income statements, understanding revenue, understanding expenses, which are really the backbone of the income statement, and evaluating the performance of a business. So if we look at the course modules, these are the modules to week 8. Introduction, importance of income statement, measuring financial performance, using income statements for evaluation, and whatnot. Okay, so what income statements really report on is okay. First of all, we have to understand the difference between accrual accounting versus cash accounting. Accrual accounting is when is when expenses and revenues are realized when services are done, whereas cash accounting is done records transactions such as revenues and expenses when cash changes hand. Income statements uses the accrual accounting method rather than the cash-based accounting method that taxes use. Furthermore, income statements contains non-cash elements of a company's operations, such as a depreciation and amortization. These are non-cash expenses that are still recorded on the income statement. Revenues and expenses transactions from the basis form the basis of income statements, which shows external uses to profit or income of a business. However, unlike the cash flow statements, income statements also includes non-cash expenses, as we talked about. Includes depreciation, amortization. These are non-cash expenses that are, however, recorded within the expense section of the income statement. The income statement summarizes the revenues and expenses over a period of time. So it shows net income equal to revenues minus expenses. An income statement is important because it offers the most recent picture of a business's revenues and expenses and overall profitability. So income statements really show the performance of a company, how inflows and outflows, potentially the incomes and expenses, revenues of the company are interacting with each other. Here is a handy diagram that illustrates the uses of a business's income statement. Now, there is the internal use, there is also the external use. And we're going to be talking about some stakeholders and why stakeholders may be interested in looking at the income statement. However, if you look at this right here, we can see internal users would need to use the income statement for planning decisions, operating decisions, evaluating decisions. So this is management activities. Reporting analysis for projected income statement, actual income statement, and comparisons of projected and actual income statement. So evaluation, planning, operations, benchmarking. These are all internal uses of the income statement to see if goals and objectives are being achieved. Whereas external users of income statements may include may also have external stakeholders such as these. External stakeholders such as investors, public investors and public companies really want to see how their companies are doing. Now, the best way, if not one of the only ways, investors will be able to. Excuse me. Let me mute my microphone. Sorry, needed a cough for a second, but we're back. One of the only ways for investors to know how the company is doing, once again, investors many times are owners or lenders or creditors. These stakeholders have a vested interest in how the company is doing, whether or not the company is growing, whether or not the company could pay back its obligations. Managers also are users and stakeholders of income statements. Okay. All right. So elements of the financial statement, we can see three main types: assets, liabilities, and equities. Economic resources are assets because they present an economic resource controlled by the entity that is expected to result in a positive economic benefit. Claims could be either claims by the owner that is left over, or what we call owner's equity, or claims could be liabilities. Because, for example, you may put a piece of land, a piece of property, plant, and equipment up as collateral. And therefore, creditors have a claim on this piece of property. So it could be a liability, even though it is an asset, because there are claims on it that this could potentially be a liability. Presents an obligation to the entity to transfer economic resources as a result of past events. So a prime example of this would be bonds, company bonds, corporate bonds. Right? These are liabilities. A past event would be the company selling these bonds. Now, because of these bonds, a company has an obligation to transfer economic resources, which are payments, usually principal plus interest, to these creditors. Changes in economic resources and claims reflecting financial performance. So income, potentially this is the residual or the leftover after expenses are deducted, or revenue, increases in assets or decreases in liabilities that result in increases in equity, or other than relating to the contribution of the holders of equity claims. So income from operations, income from net sales of property, plant, and equipment are examples of changes in economic resources and claims. Expenses, quite explanatory, decreases in asset. So these are all recorded in the income statement. Other changes in economic resources, contributions from holders or equity claims, injections of cash into the company's balance sheet by owners, for example. So net income or net loss is the difference between the increases in the owner's equity, or what known as capital, known as income, and the decreases in owner's equity, known as expenses. Income is made up of revenues from operating activities or other gains, and expenses are the outflow of assets incurred as a result of generating revenue. So it's quite straightforward. Income statement often have two parts: operating income section, which includes revenues, cost of goods sold, and operating expenses, as well as other items section. Now, why is it broken down into two sections? If we think about it, okay, for example, I own a bakery. I sell bread. I have cost of goods sold. That's a cost of goods sold, operational costs, such as buying flour, labor costs, rent, water, electricity. These are costs of goods sold. Operating expenses perhaps includes operating the purchase of mittens, the purchase of a cash register machine. These are operating expenses. Whereas if I sell one of my ovens, that would not be recorded as revenue. That would not be recorded as income, because that is not my core operation. Selling my oven is a one-time injection of cash. So that would be included in the other items section. Now, my bakery example is just a very fundamental example. We could often see this in a very large scale when corporations perhaps sell off divisions. For example, AT&T recently spun off its media division. They sell the media division off. The selling off of a division of a company is not considered revenue, because that is not the core operations of a company. So the injections of cash from those operations or those movements are recorded in the other items section. Income statements must also include the name of business, name of periods of income statement, and period. So the quarter ending April, the quarter ending May or something. Anyways, so it has to have the name of business, a statement of income, so what this statement is about, and period. Revenues, I recognize when it is earned, not when cash is received. Often cash will be received later, and so we have to decrease accounts receivable and increase cash when cash is received. However, they are reported and they are recorded when they are earned. Expenses, general administrative expenses. Expenses are outflows are recognized when the cost incurred but can be measured reliably. Most expenses result from the production or delivery of goods and or services during the accounting period, including the cost of goods sold. Operating, selling, and general administrative expenses are also included. Okay. So we talked about this. All right, owner's equity, some notes about that as well. All right, so that's it. That is week 8 of BUSS1030. I do hope you took something away from the video. We are just doing a very quick overview of the content. Of course, there's a lot more depth. What I am thinking right now is, before we do the final exam, I would do a very long video where we go through all of the content of the textbook. So instead of looking at my notes, I would be looking at the textbook. And I'm expecting the video to be around 5-ish hours. Because I want to go into depth. I want to go into depth for the review. For me, also for the class, and for people that are watching the video. So I have a PDF of the textbook, the official textbook. I have a PDF of that. I would probably be going through it. And I expect it to be a very long video, a very dry video perhaps, but also a very important video for our review. So just keep your head up for that. That would be a special video of just a review of all the material and all the content. So without further ado, take care, and I'll see you guys next time. Goodbye.